Well, Martina, the capital has flowed aggressively toward assets with incremental risk, seeking incremental return. And I would say that the most attractive asset classes now are the ones that the retail investor really doesn't have access to. So basically what we call the private strategies are, I think, cheaper than the public strategies. The public strategies, for the most part, have been driven up in price. So real estate, infrastructure, control investing, I think these are more attractive than public stocks and bonds. In general, I'm talking about not in China or any one place, but worldwide.
Now we have seen extreme volatility over recent weeks, the Chinese stock market rout, the oil prices which have weakened even further. What kind of new opportunities does this create for Oaktree Capital? I guess you must be benefiting from that as well.
Well, I would say most asset classes have become more attractive because the recent volatility has reduced the prices. You know, it's very important that people understand that any given asset is more attractive, everything else being equal, the lower the price. So when we see prices go down, we become more interested. Most people become more interested when they see the price go up, which is, of course, the inverse of what the professional tries to do.
Now, the big thing, of course, is the US Fed, whether it's going to hike interest rates from near zero. What is your expectation and how should investors position themselves ahead of a potential move?
Well, number one, I don't consider myself to be a Fed watcher. And I don't give the issue of when they're going to raise interest rates a great deal of thought. In my opinion, the important thing is that interest rates will rise. Exactly which month they begin to rise, I think, is completely unimportant. Personally, I would not own long-term bonds because the longer the maturity of the bond, the more sensitive it is to changes in interest rates. If we expect rising interest rates, then we should have declining asset prices. And the longer the maturity, the more the decline. So I think that's the most important single thing.
The Chinese economy doesn't look very bright. The country is facing the slowest economic growth in about 25 years and stocks have plummeted about 40% since mid-June. What does that mean for you and how do you view the shape and the health of the Chinese companies?
Well, one of the things it means is that stocks rose a great deal. You know, it's one thing to say they're down 40%. It's another thing to say that they almost tripled and then went down 40%. And they're substantially higher than they were a year ago. So that in itself is not a source of concern. In fact, at lower prices, I think they're more attractive than they were in June at higher prices. We're still positive on the long-term prospects for China and the long-term prospects for Chinese investments.